Hello and welcome to this week's instalment of Nucleus Investment Insights. This week, we invite along a special guest to help us pave the pathway for the future of government bonds in portfolios. Government bonds have long been a mainstay in a properly balanced portfolio, but need to be employed with caution. As we've seen over the last few years, the cratering of central bank interest rates has seen some remarkable opportunity for those with a well constructed portfolio. The issue now lies in the air of pent up demand as people have endured lockdowns and travel bans that will now potentially put supply side under pressure, leading to inflation. Spikes in inflation lead to the prospect of rising central bank interest rates, which skewers existing bond prices and presents plenty of opportunity for bond traders to take advantage of an oversold market. To share her thoughts on the topics, today on the show we have Kate Samranvedhya, the Deputy Chief Investment Officer at Jamieson Coote Bonds and a veteran of fixed income portfolio manager. Kate has been a career fixed income portfolio manager with two large central banks in Asia. She specialises in high grade bond portfolio management across all global regions. From 2007, Kate transitioned into portfolio management, focusing on high grade bonds and managed fixed income portfolios throughout the global financial crisis. In 2010, she moved to Hong Kong to join the Hong Kong Monetary Authority as a portfolio manager, specialising in rates and cross country bond allocation. Kate holds a Bachelor of Science in Economics from the Massachusetts Institute of Technology. Her formal training combined with her deep financial market experience provides significant fundamental and policy insights to the Jamieson Coote bond investment process. Kate Samranvedhya, welcome to Nucleus Investment Insights.
Thank you so much.
Great to have you on board. Here to share his thoughts as well on the future of fixed income and how they can be used in our portfolios. I'm also joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Jim.
Great to have you on as well. And just a quick reminder before we get started, we're only 80 subscribers away from 3,000 on YouTube, and we have the goal of hitting that 3,000 mark before the new year. So if you haven't already, subscribe and click the notification bell to be notified of when we go live or have a new webinar to watch, or of course, follow us on your preferred podcast platform. We also ask if you could take a moment to click like on the video now to help our show grow. So, Kate, just to get our viewers up to speed, would you mind providing a brief background on Jamieson Coote Bonds, yourself, if you like, and also why you've focused your career on the wonderful world of fixed interest?
Okay, so Jamieson Coote Bonds was founded probably about 6 to 7 years ago by Charlie Jamieson and Angus Coote, and I've known both of them for more than 10 years by now by just trading in Australian fixed income market. And we just kind of through our career path stumble upon this very small segment of finance world in trading and investing in government bonds. And we found a company with the premise that the Australian investors are very well versed in investing in equity
Mhm.
and lately investing in hybrid. However, because historically the government bond market in Australia has been very, very small, so there hasn't been a lot of depth of knowledge and understanding in government bonds for investors in Australia to invest in. However, there is a role of government bond in any portfolio, especially in superannuation portfolio. If we look at pension world across the world, obviously they have a lot of investment in equity, but a large portion of it is invested in duration to match the liability. And this is a part that we think we can offer our expertise to the Australian market to give access to this segment in the capital structure. So we think there are not a lot of duration managers in Australia, and we want to be a part of their solution. One of the solid option for Australian investor to participate in. So the role of government bonds in portfolio, if we come from portfolio with large equity holding, you have to think about different types of investments and having different roles in your portfolio. I want to give some very basic, how to say, analogy. For example, if you go play a game of golf, you don't hit from the tee with your putter, you hit it with your driver. And then as you progress near to the hole, then you change your instrument and how you play your game. So we're going to
Mm.
argue that you need like you compare your driver to equity. It's going to get you very long, very far away, but you're very far from your goal. Once you get nearer to the hole, then you need something more finer. So think of this as a journey in your life, or like you have large allocation to equity, you have some allocation to credit, and you want to have a small portion in government bond. This is because, first of all, this is the last resort of capital preservation and liquidity when things get really bad. The best example was probably global financial crisis.
Mm.
We did study both. It's quite interesting. Both S&P in the US and ASX in Australia, from peak to trough prior to the crisis to the trough of the crisis, it took, I think, almost 4 to 5 years from the trough for the equity to regain the previous peak value, to
Mm.
regain all the drawdown. And in between these 5 years, if you had invested in government bonds before, we have no problem at any day to tap into your capital.
So when you say that, you mean it's the highly liquid. So
It's highly liquid. I mean,
yeah.
it's basically, if you look at the banks, so the APRA also requires all the banks to hold highly liquid asset. And in Australia specifically, the highly liquid assets only refer to Australian Commonwealth government bonds or the state bonds, the semi-government bonds. So these are the bonds that, when the crisis hit, you can tap access to liquidity in large size at any day. We're
Mm.
not arguing for anyone to allocate 100% to government bonds, but we're arguing that perhaps it makes sense to allocate a small portion of your portfolio to be the last resort of your holding.
Yeah. So you're certainly preaching to the converted here. We're certainly big fans of using government bonds to offset your equities, and it's along that same view as well that the corporate bonds don't give you that same exposure. So that when they obviously give you a higher yield than what you can get on the government bonds, but in times of stress, the corporate bonds, the yields tend to blow out as well at the same, just when you don't want them to.
Or in other words, they sell off at the same time the equity does. Is that what you say? It correlates as
Yes.
opposed to what a bond should do. Okay.
Yeah. So okay, but let's jump in, Kate, to more about what we want to. Well, I guess the reason for having you here is we want to hear more about your view on economics and what you're seeing in terms of markets, especially because I think it's pretty traditional for sort of observers of the market to think that people who follow bonds more closely are a lot closer aligned to seeing how the economies are going and forecasting for, say, inflation and general economic growth. Than say the equity market that's tend to be more focused on individual stories and sort of the less about the macro picture, more about the detail. And so, so I want to sort of talk about the coronavirus sort of COVID crisis. Just your views on how much of the issue is supply side and how much is demand side from the economy, and sort of which is sort of the more important side at the moment. Is it is it companies going broke and sort of lack of supply, or issues with supply chains, or is it more about people being unemployed and not having the money, and so demand being the real issue?
Well, if you look at the economic data, the manufacturing PMI actually made almost back to 2019 level, which is very healthy level. Is the service side, is the people going out and spend that is still lacking. And this is natural because with COVID, everyone stays home. And we're not going to have the large scale activities or the mobility that society used to for perhaps like another year. The good news is the vaccine is coming. It will be slowly phased out. I expect that by the third quarter next year, a large percentage of population will be vaccinated and will create enough herd immunity so that our society can mobilize again and the service sector will bounce back. Now, if we talk about supply side, demand side, in this crisis that I have to say is that once in a 100 years kind of crisis, the government has stepped in. They asked everyone to stay home over lockdown, and they spend a lot on stimulus, giving money to people to basically stay home. This is pretty much global. So almost across all countries that we look at, saving rates of household sectors have actually risen quite substantially to the tune of, let's say, 15 to 18%. And when saving rates rise, the government offset that lack of investment by borrowing in the economy and spending money, basically. So what we should see next year is by the third quarter, we should see people starting to spend. I think the term that you will hear a lot next year is pent-up demand. People are dying to get out to basically regain their normal life. I mean, we all have been in lockdown for so long. Like actually Singapore, the government just basically gave Singaporeans vouchers to spend on local hotels. Last weekend there were 5 hours queue just to check in. So that's a sort of
I've had a similar thing here in Victoria with I think the website went down for trying to give away vouchers for regional Victoria, and I think they've had to issue a whole bunch more now.
Yeah. So that's the sort of thing that we would expect to see next year. And on the supply side, yes, we definitely have seen that because people are not going to work, so things are not being produced at the same speed, that things that are slowed down. However, because medical side is resolved now, we're just waiting for time for this to happen. So what's likely to happen next year is perhaps, we can have global synchronized growth with both supply and demand coming back online. The issue with inflation is going to be quite a big debate next year. First of all, we have base effect from inflation being destroyed through the pandemic in 2020. It's going to come back next year just from base effect. What we don't know is how much inflation will rebound through this pent-up demand and the destruction of supply from companies going, bankrupt, businesses closing. We don't know, because I think demand side, there's so much saving in the household sector that the demand side will bounce back. Supply side, it takes a bit of time for supply to come back. So there's a bit of likelihood that inflation will come back. I'm going to take one step further. Once inflation comes back, how much of it is sustainable? Like we know that spot inflation will rise next year. We just don't know how much and how sustainable that inflation will be. So that's going to be I think the big debate for 2021. And on top of that, yeah.
Sorry. So given that you're expecting it to be mainly on the services side, and there's relatively high unemployment at the moment in a lot of countries, do you think that's would seem to suggest that it's a temporary thing?
The unemployment, so yeah. So the two sides arguing about inflation. the ones arguing for high inflation would say, okay, because the supply cannot bounce back as fast as demand. However, there's a very valid argument on the other side, which is wage growth cannot, because there's so much unemployment, wage growth just cannot bounce back that much. And that's a very valid argument on both sides. It's just temporarily there will be like a bump in inflation. But over time,
Yes.
because wage growth, because if you look back into, let's say, the 70s and the 80s, back then, workers got unions. And when they are in unions, they have more negotiating power and they were able to negotiate for higher wage. But now, like, that structure has been gone for a long time. Hence, now workers are more on the part of accepting the wage that is offered to them. So that is still pretty structural and has been, I think, pulling down wage over the years. We also have, so let's run through the structural setup that has been dragging down inflation globally over the years. We have wage growth has been coming down. Like, one, we have aging population. Two, I think since 2001, when China joined WTO, then we have suddenly larger supply of labor in the world to produce goods, right? Two, let's look at, let's say, the past 10 years. The companies that have added to the productivity, the companies that changed the way we live, these have all been technology companies, or mostly technology companies, and they require very little capital to produce,
big profits.
Yeah, basically. So we just have too much capital chasing in return. What else?
So let's say we're running through the supply side, because I guess that's what we're thinking through is let's say it's a you're an airline coming back on, or you're a restaurant or whatever it is, and so you're an airline coming back on. You've got a more limited number of planes now and staff, and so when more people want to fly than what you have capacity for, you'll bump up your prices to bring back, and same with the restaurant. You'll more people want to book, and so you bump your prices up a little bit, which gets that inflation we were talking about. But I don't have to go and pay my workers anything extra, because I know there's more stewardesses out there who haven't got their jobs back yet, or there's more waiters and waitresses that you can go back and bring on, and because they're unemployed at the moment, you're not going to be increasing your wage bill over time. So I guess that's what I'm thinking is, it seems to me like a transient inflation, because it'll end up in company profits for a little bit, and the wage growth isn't actually going to come through in terms of, okay, I need to actually start paying my workers more money for quite some time. Is that how you're seeing it?
Yeah. That I think that's how it can play out next year. In the market, though, I feel like, because like once we have a little bit of inflation, people get too excited, and people tend to, let's say, trash talk bonds. However, every year we tend to look for, let's say, 100 basis point range in bond yields to move.
Which when you say 100 basis points, which at the 10-year bond rate?
Yeah, let's say the 10-year bond rate.
Yep. Okay, so 50 up and 50 down from a central. And what's your central position for it then?
Well, depending on which year, some years. So last year we started with, let's say, U.S. Treasury. Last year, at the beginning of the year, no one would think the direction of the rate is actually one way down, because we started the year at the end of the year just under 2%, and then it fell like to 32 basis point at the lowest. So this year, let's say if global synchronized growth comes back, we have a little bit of inflation, we have a bit of rise in bond yields. However, since like if there's this structural thinking that wage growth will still be low, there's still too much capital chasing um, return. And there's a third factor, which is throughout this whole pandemic thing, governments around the world added so much debt to the system. With the weight of the debt itself, bond yields cannot rise that much.
Okay.
Right? So we're not thinking that okay, we're gonna go like a few percentage. We're thinking the next direction is up, but it's gonna be up a little bit, which is a healthy adjustment in bond yields actually.
So just on that, Kate. So do you see using this scenario? So we've got some supply side pressure pushing inflation up, whether it be sustainably or not. And then obviously we get a spike in bond yields, which means the price is falling. Do you see that as an opportunity to sort of get in as a bond manager? Is this, is there something in that scenario that's enticing to you to sort of, refill the portfolios, or do you see, do you see opportunity in the
Definitely,
short term? Yep.
definitely. When there's an adjustment in bond yields up, that's a very, very good time to go and buy your duration.
Right. Interesting. Okay.
Yeah. So as long as and I guess the flip side from a as the people you said were concerned about inflation, there are a bunch of people out there who are saying, inflation's waiting, it's under your beds, it's ready to come out, and all this government money printing is going to lead to dramatically higher levels of inflation, and so I guess they'd be saying, well, if bond yields start to rise, they'll be like, it's the beginning, it's all begun. Bond yields are going back to 5 and 6%, is what I guess is their argument. And it sounds like you're on the same side of the boat as us in terms of saying, no, we think it's transient. We think the inflation will wash through, and then we'll be back to where we've been for the last 10 years, which is, not being able to generate inflation, where Japan's been for the last 25 years. And so it's an opportunity at that stage. Is that
Yeah,
good words in your mouth?
I completely agree with that statement. I think for investors, there will be noises coming out to paint a very bearish scenario for bond market. However, we have to remember the structural reasons why bond yield are so low or have been falling for the past 30 years. And those structural reasons are still there. We still have aging population. We still have mountains of debt, both public and private debt. And
well, because I guess that's that part where if interest rates were, even 5% overnight, went to 5%, that would basically send, I don't know, 30% of Australia bankrupt, I suppose, of people with their mortgages, and plus local governments and state governments and all that type of stuff would be turning back to the federal government for handouts. Yeah. So is that point, isn't it, that there's so much debt out there that if rates are going to rise, they need to rise really slowly to give these people a time to pay off the debts that are there.
A slow adjustment upward in bond yields is very healthy as economy heals. So we should be expecting that. A spike from, let's say, 1% to 5% is I don't think it can happen when debts are this large. Actually, it's not gonna be sustainable for economies anywhere in the long run. And all the business of that is based on the fact that inflation can be tamed right away if the central banks decide to raise interest rate. And I think central bankers around the world are very comfortable with the fact that if they raise interest rates, then they can cure inflation pretty effectively. However, on the flip
maybe
side,
the economy.
well, that's what Paul Walker kind of did, like during his time, and he got so much, I think, hate mails at that time. But he stuck to his gun and he brought the interest rate down. So, what we want to avoid is the economy getting to that stage by the central banks acknowledging that, okay, we cannot get it to that far ahead. I'm going to bring back one other change this year, which is the Fed adopting average inflation targeting. And this is allowing inflation to rise above 2% for some time before they react. So if you look at the average inflation in the US over the past, say, 10 to 20 years, the average is around only 1.7%. Spot inflation in the US rarely rises above 2% sustainably for a long period of time. So the Fed intends to let it rise above 2%. And from by the nature of my job, I listen to Fed speakers. The sense that I get from them is they're gonna let this number rise above 2% for about 1 year, and then they're gonna react, which means possibly they're gonna stay on hold, as they said, until 2022-23, and then they will react. And this kind of, in a way, it gives time for the economy to heal from economic scarring from 2020. And I think what they're more afraid of, I think they opt for this solution because in the past, let's say since global financial crisis, they are always a bit kind of more afraid of deflation rather than inflation.
So just on that, what are your thoughts on inflation-linked bonds? Do they have a position in your portfolio? Sounds like they might in the future if you use them.
We can invest in inflation-linked bonds. We don't have a lot of allocation to that sector right now. One of the characteristics of inflation in Australia itself, inflation-linked bond is still a very small part of the government issuance. And if you want to promise liquidity as our main offering, then that's still tiering, like government bond, like nominal government bonds still offer the best liquidity compared to inflation-linked bonds. So yeah, there's some role in the portfolio, and I think everyone can invest a little bit in some, but I think the majority of our portfolio will still continue to be nominal bonds.
All right,
so actually, just to get a little bit back to some of these thoughts you had as well. So you're looking for the longer term bond rates to rise as inflation scares sort of take over, and then using that as an opportunity to get back in. At what stage? So the RBA has anchored some of the shorter term bonds. So I think they've spoken about they've got a specific target for the 3 year, and they've got a dollar target, I think, for the 5 year that they're buying. Is that right?
They have yield curve control basically in the 3-year part.
Yep.
And the policy that they announced at the beginning of November is to allocate $100 billion to buy around a 5 to 10 year sector. It's just not an explicit target, but it is a quantity promising to buy that sector of the market.
Yes. So at what stage, I guess, where are you looking then? So if you had 5 year bonds, for example, or 6 year bonds, would you be concerned that in terms of yield starting to increase there, or do you think the RBA is going to be able to keep that sort of part of the market relatively anchored? So let's say we're talking about the 10-year bond rate rising to 1.25, 1.5%. Are you expecting that the 5 year is going to move up a bit as well, or do you think that the RBA is going to be successful in terms of keeping that anchored?
The interesting thing about the Australian fixed income market is that, there are two things. One, from my experience, the 10-year point of Aussie bond yields are a combination of where 10-year US Treasury trades, plus the expectation between the Fed versus the RBA policy rate over the next few years, for example, over the next year. So oftentimes we use like 1 year short-term rate expectation to compare relative path, who's going to be more dovish or more hawkish. And that dictates the direction of where spread will trade over the next, let's say, period. So I don't think RBA has control over where US Treasury trades. However, the spread between the Australian bond yields and US Treasury, they can influence it actually not really by the quantity of the bonds they buy, but by communicating their relative dovishness compared to the Federal Reserve's path. To put it into easy term, if the Fed say the Fed is going to stay on hold until 2022, RBA can have a lower bond, can achieve lower 10-year bond yield by communicating that, okay, we're going to stay on hold 2 years longer than the Fed. I think that's a bit more effective. The second part of this is also the quantity of the bonds that they own. In Australia itself, futures market is not fiscal bond settlement. You don't have to own bonds you don't have to deliver bonds basically if you gonna buy or sell the futures. Whereas in the US or in Japan, the futures market requires fiscal settlement. So if you sell bond, if you short bond, then you really have to deliver the bond. So you have to go buy bonds in the market and deliver it if you have been selling futures. So
that's not a feature of the Australian market.
So that's the nature of it, which it served the purpose of the market for the past, I think, 10, 20 years, because in the past, the bond market size has been quite small, but because the future market doesn't require fiscal settlement, it promotes the sort of liquidity. It promotes more market participants that who don't really have to go and buy bonds to settle in the market. So let's bring it back to today. If you don't need to really own physical bond to settle in the market, people who can affect the price of the bond via future can be anyone who has enough balance sheet to move the price at the margin. So I'm a little bit skeptical on the quantity of ownership of the bond in that particular segment. It's not the first time that a big hedge fund has won over a central bank, if I can refer to George Soros and Bank of England. So I think RBA can utilize more forward guidance on the path of rates.
Right. Okay. So let me get this right. So the 3 year they've got an explicit target. So you're not expecting them to lose control of that, though, are you?
Well, if they especially say they're not going to raise rate for 3 years, that is pretty credible.
Yeah, and they've said as well that they've got a target of 25 basis points, that they're going to keep buying bonds. They're basically going to buy an unlimited number of bonds to get it back to that level. Anyway, is that right?
Yeah. So I think what affects bond yield more is also the intention of the central bank to be credible on their interest rate path. So for us, we have we can model, let's say, our assumption on where the central banks will move their interest rate policy, and if RBA is very firm and credible on not moving interest rate target, which at the moment is about 10 basis point for the next 3 years, then the 3-year point will not move.
Yep.
Until, let's say, we get nearer to year 2022-23, then just because we're moving a long time, and once we get to 2022, the 3-year point will naturally have like a upward bias because we're gonna discount cash flow from 2023, 24, 25.
Yep. Yep.
So
Okay.
nearer that
So
time, RBA will have to adapt their communication, basically.
yep. Yeah. Okay. So let me get this right. So we're going 10-year bonds up, whatever, 50 basis points or something like that, or in that ballpark, depending upon how good the economic news is and everything like that. The 3-year stays pretty pinned. This is for next year, and then the 5-year probably does start moving a little bit because you don't think the government's got as much control. The central bank's got as much control over that as they might have, even though I guess the money they've said they're going to spend wouldn't be enough to stop the yields from moving. Is that a good summary?
Yeah, I think that sounds about right.
Okay, excellent. So, so let's change tack a little bit and have a talk a little bit more about the US. So Janet Yellen, as Treasury Secretary of Treasury, what do you think that means in terms of how the relative importance of fiscal policy versus monetary policy, and what are the benefits, I guess, or detriments from having an ex central banker running your fiscal policy?
I think the last time that I heard Yellen spoke throughout this crisis, her main point was that the Fed could have been clearer and more provided like a more definite path of support throughout the years. She also thinks that I think the positive thing about having such a veteran to run the Treasury is I think she understands that we get to the point where the Fed can provide the stimulus, but it's not going to add too much difference to the economy. And
Yes.
the big help will come from the physical side. And what her task is really from now until, let's say, the third or the fourth quarter next year, to provide the sort of fiscal support that will enable the economy to recover in a smooth path. I think she fully understands all this. The detriment, I think, might have been like, I think people might suspect whether she will be too dovish. She will overstimulate the economy. I got to say that when she became the Federal Reserve chairman, this has been the perception all along, and I do think that she can communicate also when things get overheated. However, we never get to see that side of her throughout her, I think, tenure at the Federal Reserve, just because during that time, we're in a healing phase of the economy. She's actually the chairwoman who, introduced balance sheet reduction on plan, introduced forward guidance, introduced the dot plot. She also raised interest rate. So I think there's a lot of experiences going for her.
And
One
spoke
thing I
about
have to
letting
say,
the economy run hot as well.
I don't think that that's entirely up to Yellen. I think that's more of what President Biden wants to do.
Oh no! Sorry. I was just saying. Janet Yellen was the one who sort of first spoke about letting the economy run hot to sort of offset some of the weaker periods as well.
I think that fits into the Fed's current policy of average inflation target.
Yes.
So by letting it run hot temporarily, we're not talking about. Hopefully, I mean, this is the first time that we will get a different mode of Federal Reserve. But I think they understand that they don't want runaway inflation in a tune of 4 to 5%, but they would like inflation to be above 2%, maybe for a year, and then they can bring it down a little bit. I think they have a greater confidence in their ability to bring down inflation than the ability to rescue inflation out of zero. It's very hard to bring economy out of deflation.
Yes.
But I want to
Okay, so
finish my point on
okay.
overstimulate the economy. I think if you want to overstimulate the economy through the fiscal side, I think it is not entirely up to Yellen. It's up to the Congress, and the Congress, specifically the Senate, which we don't know the result yet because we have the last 2 seats to be decided on January the 5th in like 2 weeks. That's how thin the margin is. So the Republican needs to win 1 seat.
Yeah. So it
And
seems
then
to me that the odds are basically, given people are voting for 2 Republicans, or 2 Republicans or 2 Democrats, it's sort of the odds of it being split seems to be a little unlikely to me. It seems to be more likely to go both to one or both to the other. And then the second part is, I've got no idea whether there's going to be a bunch of Trump supporters who don't turn up now because he's not there to vote for, but there's also going to be a bunch of people who were against Trump who don't turn up to vote because he's not there anymore. And what that actually does, who's, which one of them, because the turnout was so huge for the election, I'm assuming the turnout's going to be a lot smaller. I don't know if you've seen what the best analysis you've seen out there is in terms of how big the drop-off is going to be and who's going to be dropping off more.
the voters turnout in 2020 U.S. election was absolutely mind-boggling. I think it depends on how much they campaign in Georgia, and both parties realize how important this election is. I would say, the drop in turnout, whether Trump is there or not, both sides are valid. I would say that I don't think Trump will really disappear from the media. He may lose presidency, but he loves Twitter and he loves having a platform to communicate his view. So now that he's actually quite free from having presidential duty, I don't think he will really disappear into quietness. And most presidencies that retire from the office, I think historically, all of them try to commercialize themselves somehow, except President Bush. I think President Bush is already quite wealthy. Clinton tried to have a foundation. They founded Clinton Foundation. The Obamas wrote books. President Trump, I think he is likely to stay on media, and he will continue to I don't think he will be quiet. That he will continue to make noises and criticize the Biden administration. And there's such a huge following of President Trump within the Republican Party that it can continue on even beyond the Georgia election.
Yep, no, okay. That's a likely, and that's probably a reason why. I mean, I'm guessing that he would be predisposed to less stimulus rather than more stimulus. Given, I guess one thing is, given the way I guess the Republicans reacted post the financial crisis, where they were very keen to have less stimulus, and whether that was a disingenuous move because they thought that would mean the economy would do worse and they'd be able to get in next, or whether they genuinely believed that they needed less stimulus. It's hard to tell, but it would seem to be that that would be what they would be trying to do this time as well, is less fiscal stimulus.
So creating economic pain, essentially, because they're not in anymore.
Yeah, whether that's what they truly believe, or whether it's disingenuous, who knows? But I guess is that what you'd say your thoughts are as well?
Yeah. So historically, if we have split government, usually that's pretty good in terms of managing the government finance, and we can have a bit less stimulus. But I don't think it's going to be in a tune that will hurt the economy, is still going to be enough to carry the economy forward. The kind of, if we happen to have like a Democratic Congress, then the tune of spending that the Biden administration dreams of doing it can be in the tune of $3 to $4 trillion over 4 to 5 years, which is huge. Like, this is even, when President Trump spent, I think his package in 2016 is 1 to 2 trillion over 10 years. So this is hugely stimulative. Like, Biden has a dream of being FDR, of giving the New Deal. So
Yep.
that's
So
that is a big factor that will change our assumptions quite a bit.
right. So okay. So that's where I was leading to with this. So let's say I think the betting market's basically going 70%, or maybe 2/3 to the Republicans getting it and getting control, and 1/3 to the Democrats getting control. If the Democrats do get control, it sounds like you'll be revising upwards your inflation expectations pretty quickly, and then I guess your bond yield targets before you'd want to start buying again. Is that right?
Yeah, I think that would fit the bill.
And
Just be
so,
a bit more patient.
Okay.
Yes, certainly something to think about. So on that same part, I guess. So there's been a lot of stuff about whether the gig economy is sort of affecting, and the idea that a lot of people are working a lot more part time is sort of affecting unemployment statistics around the world, and about whether underemployment is a better measure, and whether the focus is too much on unemployment, that what you might find is that you're exiting your stimulus too early. I'd just be interested at seeing, they had the was it the non accelerating inflation rate?
Nauru.
Nauru, yes, we got that. So basically, how low can unemployment get, for anyone listeners? Just how low can unemployment get before it starts causing inflation? And I guess over the last sort of 10, 15 years, that number just keeps coming down and down and down as everyone thinks, oh look, whatever, it's 6%, and then no, it's 5%, and it's 4%, and so I guess the question is, do you think that's as simple as that unemployment's not being measured correctly, or do you think there is a level at where do you think the level is, I suppose, and should we be using underemployment rather than unemployment?
So Nauru is not a measurable concept. It is like theoretical concept where the economy reaches full employment without creating inflationary pressure. And it is observed, but it cannot be calculated, basically. And obviously it changes over time. Same as potential growth. Like you don't know where it is, but you kind of know afterwards, after the fact, basically. I think what central bankers or policymakers do is they look at both all unemployment rates, underemployment rates, and inflation all together, and make judgments as the time comes. So I cannot say that one measure of unemployment can replace the other, but you just have to use all these data together.
Okay, so jumping again to a different track, we've sort of been looking at the term funding facility in Australia, and so just for any listeners, it's basically a mechanism whereby the RBA lends directly to banks for either business loans or mortgages, and they on the 3-year rates, and they'll loan at is it 0.1 now? I think we'll start at 0.25 and now it's 0.1. And so I guess for us, that sort of means that in terms of the economic future, that seems to be the more important rate than the overnight rate. I don't know whether you have similar thoughts or different thoughts.
So this matters when you look at the overall composition of the bank's funding sources. So really the major source of funding of the banks in Australia, I think 50 to 55 to almost 60% comes from deposits. And then the rest comes from short-term debt and long-term debt. I think term facility will fall under short-term debt, which is, I think, 15 to 18%, which is around the same amount as long-term debt. I think it adds to the funding of the banks at the margin, but it's not going to be changing big picture for the composition of the funding for the banks.
But in terms of the rate, though, I guess what I'm thinking is the standard variable rates haven't moved very far, but the 3-year rates have dramatically decreased over the last year. And so for anyone getting a mortgage, it just means that getting a 3-year, they can get something with a 1 in front of it now, or definitely a 2 in front of it, whereas that's not the case for a standard variable rate.
Right. Yeah. So if you look at the net interest margin at the bank, net interest margin at the bank has been like right now it's just over 2%.
Yep.
So like I think the question is really about passing through, like in terms of the RBA's policy rate to the mortgage borrowers. Is that what you're trying to do?
Yeah, I guess what I'm saying is, what the RBA does so from the average person out there who's looking to get a small business loan or looking to get a home loan, the standard variable rate, what the RBA does with the standard variable rate, hasn't mattered this year as much as what they've been doing with the term funding facility.
Okay.
Kate, if you do you want us to cut this bit out? I'm happy to cut this bit out if you don't want to comment on it.
Chuck it in there. That's okay.
Up to you.
Yeah. So okay, for this bit, I think you have to look at the bank's funding as a whole, as in deposit rate, short-term funding, and a long-term funding. I think the point that I want to make is all these rates have come down in absolute level, whereas the bank net interest margin has narrowed a little bit, but it's not that much. So basically, banks have maintained their profitability throughout the year. Like I hear you, the standard variable rates have not changed that much. I think what I want to say is the problem with getting loans these days is more like how the banks want to make what's the word the easiness of getting loan from the bank. I think
it's the assessment, the creditworthiness.
Yes.
Creditworthiness. Yeah. Yep. Okay. The other one. So just cognizant of your time, and thanks for sticking with us for this. Negative interest rates. You're thinking they're likely in Australia, not likely in Australia?
I think it's been great debate between Europe and the US on the effectiveness of negative interest rates. I want to take it all the way back to 2014 when Draghi was introducing negative interest rates. He was saying at the time in his speeches that the Fed went to zero and it took them, let's say, 7 years to stay at zero policy rate before they were able to take the stimulus away. But Draghi at the time said that he's gonna implement negative interest rate as an accelerator so that the European economy can come out faster than the Fed, basically. Now in 2020, that is not what happened, right? Like we're still deeper into negative rate, yes, but yes, we did just have a pandemic, 1 in 100 years kind of pandemic. No central bank who's gone into negative territory has, come out positive again. I think the only exception is Riksbank, who took it from negative to zero. The rest have been stuck at different levels of negative rates for some time. Like, if I look at the ECB paper, they argue that negative rate has attributed positively to the economy because they look at the loan demand and the loan growth numbers are very healthy. They cushion the bank's net interest margin by implementing tiering. There's also benefits of the assets on the bank's balance sheet, such as the bonds that they hold, that the level of yields have come down so much. Net of these factors is about 10 basis point in net interest margin. All these factors combined together. And recently, I think the Fed published a paper in September 2019 looking at the effectiveness of negative rates. Yes, it lowers net interest margin, especially if the banks cannot implement negative rate to depositors. And the Fed paper argues that it's not as effective as when interest rates are positive. So, however, on balance, Japan and Europe have managed it better than expectation by giving liquidity to the banks at attractive rate, basically. So all in,
You give me a bit of an economist answer here. You said on one hand yes, and on the other hand no, and so
yeah. I think what I'm trying to say, I guess, is I'm not really sure, because if you look at Draghi's argument, he say with negative rate, we're going to come out of this, we're going to recover faster and coming out stronger than the US, but it has not happened. And every central bank who's gone into negative rate has been stuck on negative rate.
Yeah, and I guess the other argument though
sure
is that the demographics are worse in Europe, and the economy is not as flexible, and a few other factors as well. It's probably It's hard to know the counterfactual, isn't it? It's hard to say, well, if he didn't do negative rates, maybe it would have been worse than what it is now. It's very
maybe. But I think one point that I think people don't talk about a lot is the factor of time. Because the factor of time heals the balance sheet. Like, it takes a bit of time to heal the damaged balance sheet.
Yeah.
But once
if you don't have deflation.
if you don't have deflation, yes.
If you've got deflation, time just makes it worse. So
Yeah, but if you look at Japan has never gone under -10. And I don't think culturally or like demographically, the banks finance themselves by having huge depositor base. These are all like demographically, they have aging population whose wealth is a lot tied to deposits. So they cannot like implement negative rates too much. So I think the social contract in Japan doesn't really allow for a hugely negative rate. I think it's experimented. They really had to do it at the time to prevent yen from appreciating too much against euro and US dollar. But now that yen is stable, I think Japan, I just think they don't want to change things too much. So coming back to Australia, I think you really have to, I think the central bank has to make a decision, like culturally what is acceptable. The banks rely
And
on
it's safe to say that at the moment the central bank said no, they won't have negative rates. So yeah, it's going to take a fair bit, is what it sounds like.
Well, the thing is, the RBA has said so many things that they wouldn't do, but they end up doing it anyway.
Exactly. But it takes them a while. Yeah.
A bit of a problem. If you look at RBA and SAT, they have been talking about implementing negative rate for I think the past since March or April. BOE, Bank of England, also talked about negative rate. But once they heard of the vaccine, then they both have become non-committal. So I think the credibility lies on really believing in, one set of belief. Like, are you going to believe in just non-negative near zero for a long time, like the Fed, let's say from 2008 until 2015, or are we going to experiment with negative rates? And I think it's not just, in my humble opinion, it's not just the economy, it's just how it affects society, how it affects savers and pensioners who may not have the time to chase assets like in equity, because they really need money for their retirement.
Very good. All right. Any more questions, Damien, or we can?
No, we might let Kate go there. Thanks heaps for that, Kate. That was that's been very useful.
Yeah,
Really
fantastic. And thanks. Yeah, great to have you on the show, and thanks for taking some time from no doubt a busy day to share your thoughts with us and answer all our tough questions. Would you mind just sharing with our audience, if you like, of course, just ways they can follow your work and obviously the work of Jamieson Coote Bonds?
Our website is jamiesoncootebonds.com.au. Viewers can subscribe to receive our regular insights and market commentaries here. You can search for Jamieson Coote Bonds on livewiremarkets.com and click follow on my profile to connect with me and my content. You can also connect with us on LinkedIn by searching Jamieson Coote Bonds and click follow. We are active on LinkedIn and provide market insights, education, performance updates, and video. There are 2 easy ways to invest with us. Firstly, through direct application via the forms available on our website, or through a range of supporting investment platforms listed on our website under the Invest With Us section. This is the same process for our 3 funds: the Domestic High Grade Bond Fund, our Global High Grade Bond Funds, and then our latest fund, the Global Absolute Return High Grade Bond Fund. Thank you.
Excellent.
Yeah. All right. So, thanks again for your time. And we really look forward to getting you back on the show sometime soon, Kate. All the best.
Thank you so much.
Thanks to all of those who've watched today for another great episode. I hope you've taken away some great ideas. And if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head on over to nucleuswealth.com/content. To stay up to date on news from us, follow us on social media. And finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend, and help our show grow. Thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you with the next one. Cheers.